What if there was this tool, often kind of overlooked, that could just completely change how you see financial markets? Like, imagine having a window right into the immediate plans of buyers and sellers, not just what happened, but what's going on right now, giving you this incredible edge. Today, we're doing a deep dive into something called the order book. Yeah, it might sound a bit intimidating, maybe technical at first, but honestly, it's one of the most dynamic and revealing things a trader or investor can really get to grips with. Think of it like a live list, constantly updating, showing all the pending buy and sell orders for an asset. It's like a battlefield, really, where supply and demand meet head-on in real time. So our mission here is simple. We want to pull back the curtain on this order book. We'll break down the key parts, really understand why it's so important, and crucially, explore how you can actually use its insights. And we're drawing all this from the great sources we've gathered.
It really is fascinating because, the order book often gets taught in this really complex way, but fundamentally, it just gives you this raw, unfiltered, real-time look at market sentiment. If you just step back a bit, it's about getting this really granular view on supply and demand dynamics, something even the fanciest charts can't quite capture in the same immediate way. It's almost like looking behind the curtain of the market, seeing the hidden currents that are actually pushing the price around.
Okay, let's unpack this battlefield then. So at its heart, the order book is basically this detailed list, right? It shows exactly who wants to buy, who wants to sell for things like stocks, ETFs, futures, even crypto. And critically, at what specific price they're willing to do it. It's not history, it's now, it's live intent.
Yeah, and to really get a handle on this, our sources used a great analogy. Think of a busy auction house. The order book is that room. You've got buyers shouting out their maximum bids, sellers yelling their lowest asks, and the second they agree, bang, a trade happens. And the sheer number of orders, like the size of the crowd at each price level, it shows you how strong each side is, how eager are the buyers, how desperate are the sellers. It's a live painting of market psychology.
That auction house idea really works. Okay, so who are the key players, the key bits of info in this digital auction room? First up, we've got the bid. So the bid is the highest price any buyer out there is currently saying they'll pay for the asset. Top of the buy queue.
Right. And on the flip side, you have the ask, sometimes called the offer. That's the lowest price any seller is willing to accept. That's their floor right now. Now, the really interesting bit is the gap between those two. The bid-ask spread. This isn't just a number. It's a direct signal about liquidity. How easy is it to trade this thing? A tight spread, maybe just a penny or two, tells you there are loads of buyers and sellers really close in price. Trades happen fast, efficiently. Good sign. But a wide spread, that suggests maybe a thinner market, fewer people participating right now. It might cost you more to get your trade done or be harder to get filled at the price you want. It's a quick health check for that specific assets market.
Makes sense. Then there's order size.
Yeah.
So this tells us how many shares or contracts are up for grabs at each price point. It's not just what price, but how much conviction is behind that price, measured by the volume of their order.
And building right on that is depth. This is super important. Depth goes beyond just the very best bid and ask. It shows you all the layers, the stacks of buy and sell orders at different price levels further away from the current price. It reveals where the potential pressure points are, those walls of money waiting to buy or sell if the price moves. It gives you clues about where serious support or resistance might show up, or conversely, where the market might be thin and could move really fast. It shows the real underlying conviction or lack thereof.
Okay, let's nail this down with an example from the sources. Imagine you're looking at an order book and it says, bid, $100 and the size is 500 shares. Ask, $100, 10 cents with a size of 400 shares. Just looking at that, what can you, our listener, figure out instantly?
Right, well, straight away, you see that 10-cent spread between the bid and asks. That's pretty tight, suggests good liquidity, like we said, healthy market right there. And the fact that there are 500 shares wanting to buy at $100 versus only 400 shares offered for sale at $100.10, it gives you that real-time picture. Buyers have a slight edge right at the very front of the queue, but there's still a decent amount of supply just 10 cents higher. That kind of balance often points to a market that's, relatively calm and pretty well supported at that exact moment.
Okay, so we've taken apart the pieces. But why does understanding this whole battlefield actually matter? beyond just seeing who wants what? What's maybe the most surprising thing the order book tells us about supply and demand in real time?
That's a really good question. It gets into the deeper stuff. Beyond just the immediate orders, the order book helps spot potential support and resistance levels. Think about those big buy walls we mentioned, large chunks of buy orders all stacked up at one price. They can act like a barrier, suggesting the price might have trouble falling below that level. And the opposite, big sell walls, lots of sell orders piled up above the current price, they can act as resistance, like a ceiling, making it hard for the price to go higher. But, and this is really crucial, how reliable are these walls you can see? That's the big question.
Yeah.
Because these orders can be pulled instantly. So those walls aren't always as solid as they look in that auction house.
Right. And this is where it gets really interesting, where the deep dive stuff starts coming out. Our sources spend a lot of time on how market makers, big institutions, they often use the order book to deliberately hide or reveal their intentions. They're almost never showing you everything they plan to do. Understanding that game, that perception management, is so key to actually navigating this thing. And if these big players are playing games, they're using specific instructions to do it. Which brings us perfectly to the different order types you'll see. These aren't just jargon, they're like the language of intent. You've got limit orders. These are very specific. You're saying, I only want to buy at $100, not a cent more. Or I'll only sell at $100, not a cent less. You name your price. Then you have market orders. These are all about speed. Get it done now. You're basically telling your broker, just buy this for me or sell it right away at the best price available. You prioritize getting filled over the exact price.
And then you get one of the most fascinating ones, iceberg orders. These are really clever. These are huge orders, but they're hidden. Only a small piece, the tip of the iceberg, shows up on the visible order book at any one time. So a big institution might want to buy, say, 1 million shares, but they'll set it up so only an order for 10,000 shares is visible. Once that 10K gets bought, boom, another 10,000 automatically appears from the hidden part. It looks like small orders, but underneath. It's not just another order type. It's a massive clue about how the visible order book can be, well, a bit of an illusion sometimes. It hides the true size and intention of big players. It hints at this much larger, hidden demand or supply that can quietly soak up shares or feed them into the market without causing a panic. It really makes you question what you're actually seeing on the surface.
That completely changes how you might interpret things, doesn't it?
Wow.
Okay, lastly, we have stop orders. These are conditional. They only become active if the price hits a certain trigger level you set beforehand, like sell me out if the price drops to $99, that's a stop loss, or buy me in if the price breaks above $101, maybe to get your breakout. They're key for managing risk and automating entries or exits. So with all these moving parts, these hidden layers, how do different traders actually use the order book? How do they try to get an edge in this arena? Let's start with the really fast movers.
Yeah, the scalpers, they're the sprinters of the market. For them, the order book is pretty much everything. They're literally watching the order flow tick by tick, looking for tiny imbalances, tiny shifts in buying versus selling pressure, trying to grab just a few cents profit over and over again all day long. Their whole game is reading that immediate pressure. But host, thinking about what we just said about hidden orders like icebergs, what's the biggest risk they face relying only on that super short-term view?
Yeah, exactly. That short-term focus makes them super vulnerable, right? A big hidden order suddenly appearing, or a large visible order just vanishing. It can instantly wipe out those tiny profits they're chasing. So moving up a bit in time frame, what about day traders? They're still focused on just today's session. How do they read the book differently from a scalper?
Day traders might still watch the flow, but they often zoom out a little more. They're more likely to pay attention to those larger buy or sell walls we talked about. For them, a big wall isn't just a momentary thing, it's a potential signal for a bigger event. Maybe a price reversal if the wall holds strong, or a breakout if the price smashes through it. That suggests a real shift in momentum. They're looking for bigger moves within the day, so the overall structure, the depth of the order book becomes more important to them.
Okay, and what about traders with longer horizons? Swing traders holding for days or weeks, or position traders holding even longer? Is this constantly changing order book still relevant for them, or does it just become noise?
Yeah, for these longer-term folks, the minute-by-minute flicker of the order book It's definitely less critical for their main decisions. They're usually relying more on fundamental company analysis or maybe weekly or daily charts for technical patterns, but
Hmm.
it's not totally useless. They might still glance at the order book, especially around key price levels they've identified from their longer-term analysis. They might look for those significant liquidity zones areas where large orders tend to cluster just to see if the order book confirms their thesis about broad support or resistance. It's more of a confirmation tool than a primary signal for them.
And then there are the market makers. You mentioned them earlier. Their whole business is basically inside the order book. How do they work?
Market makers are, in essence, the grease and the wheels of that auction house. They're constantly placing both buy orders, bids, and sell orders, asks, at the same time. They're providing the liquidity, making sure that if you want to buy, there's usually someone willing to sell, and vice versa. Their profit comes from capturing that tiny bid-ask spread, buying from sellers at the bid and selling to buyers at the ask, ideally fractions of a second later. They handle huge volumes, constantly adjusting their orders to manage their own risks, and they are literally the ones building those visible layers you see in the order book.
Okay, so the order book clearly offers amazing insights. But, expert, you've hinted multiple times that it's not perfect, it's dynamic. What are the big warnings, the crucial caveats, the traps you need to watch out for when you're looking at this?
Absolutely critical point. Those impressive walls of buyer-sell orders we discussed.
Yeah.
They can indicate support or resistance, yes, but they are not set in stone. Orders can be canceled instantly with a click. That huge buy order providing apparent support, poof, it can vanish in a microsecond, and suddenly the price has no floor there. This constant potential for change means the battle lines you think you see are never truly fixed. They're fluid.
And that fluidity opens the door to something quite nasty, which our sources highlighted, spoofing. This is basically faking it. It's a manipulative tactic where someone, usually with deep pockets, places a large order they have no intention of actually executing. Why? To trick others. They might flash a huge buy order to make you think there's massive demand, hoping you'll jump in and buy, pushing the price up slightly, only for them to cancel their fake order and maybe even sell into the buying frenzy they just created. It's deliberate deception to move the price for their own benefit.
Which leads to the obvious question, how on earth do you defend yourself against that kind of thing in this sometimes tricky auction house? The answer really is, take a holistic view. You should never, ever rely only on the order book to make a trading decision. Connecting this to the bigger picture, it means you have to combine what you see in the order book with other tools. Look at your price charts, look at volume traded, understand the broader market context. What's the news? The order book is just one piece, albeit a very valuable, real-time piece of a much larger puzzle. Don't mistake it for the whole picture.
Absolutely vital advice. Okay, so keeping that firmly in mind, let's shift to some practical tips for you, our listener, if you want to start applying these insights. First tip from the sources. Try focusing on high liquidity instruments. Think things like the big ETFs, SPY for the S&P 500, QQQ for the NASDAQ 100, or major futures contracts like the E-mini S&P 500. Yes. Why? Because tons of people trade these. Their order books tend to be cleaner, deeper, less jumpy, and generally less prone to the kind of spoofing or manipulation you might see in thinner markets.
And I'd add, actively watch for significant imbalances. Keep an eye out for situations where the total size of buy orders right near the current price is way bigger than the sell orders, or the other way around. These clear, immediate imbalances can be pretty powerful short-term clues. They show you which side buyers or sellers is being more aggressive right now, potentially hinting at the very next price move.
Another good tip. Use the order book strategically around key technical levels you might already be watching on your charts. Think about important levels like the VWAP, volume weighted average price, the high or low point of the trading day so far, or maybe those fair value gaps people talk about. Checking the order book at those specific levels can give you extra confirmation. Are lots of orders showing up there? Does it look like buyers are defending that level or sellers are piling on? It adds another layer to your regular technical analysis.
And one specific heads up, particularly regarding options trading. While the order book is fantastic for stocks and futures, for options, it's often, well, less clean. The spreads between bid and ask are usually much wider, the liquidity can be lower, making the order book harder to read reliably. So the advice is generally, stick to equities and futures for learning. Order book dynamics first. Get comfortable there before trying to decipher the complexities of options order books.
So there you have it. We've unpacked the order book. What might seem like just a dry list of numbers is actually this unique real-time window into market mechanics, into raw supply and demand, into intent. You've hopefully gained a powerful new lens today, a
Hmm.
way to get a read on the immediate market pulse. But just as importantly, you've also heard about the nuances, the hidden depths, and yeah, the potential traps like spoofing. It's about reading between the lines, not just the numbers.
It really does make you think, doesn't it? Not just what price is doing, but who might be behind those orders and why they're there, or, just as critically, why they might suddenly disappear. Considering how fast orders can change, the potential for hidden icebergs, the possibility of deliberate spoofing, it really forces you to ask, how crucial is constant vigilance, constant critical thinking for anyone stepping onto these financial battlefields? It's a profound final thought, I think. Beneath every single tick, there are layers upon layers of strategy, psychology, and sometimes, outright games being played, all just waiting for you to decipher them.